So today we look at something called financial forecasting. Still under the topic that we have been discussing. Financial forecasting. Financial forecasting. And we write that this is the process of determining. This is the process of determining financial requirements. Financial requirements. Process of determining financial requirements in advance. Financial requirements in advance. First stop. There are three basic methods used. There are three basic methods used, which are number one, cash budget. Cash budget. Number two, regression analysis method. Regression analysis method. And number three, percentage of sales method. Percentage of sales method. Percentage of sales method. Percentage of sales method. Miriam, how are you?
I'm fine. How are you?
Fine, thank you. Karibu sana. So let's discuss the first one here. Let's start with the regression analysis. Regression analysis method. Regression analysis method. And we write that this involves developing an equation of the form y is equals to a plus bx. Developing an equation of the form y is equals to a plus bx. Using past data. Using past data. Using past data. The equation obtained is then used is then used to predict the future requirements. It's then used to predict the future requirements. Is then used to predict the future requirements. Okay, so this method is as simple as that. I was just trying to find whether you can find a question on the same, but there is no single question in the past papers that we have on the same. But basically, we just develop an equation, like maybe the equation you get y is equals to 10 plus 3x. Y is equals 10 plus 3x. Then, if you know the value of x, for example, you are told x is 20, you just now come here and say y is equals to 10 plus 3 times 20. So this will be 10 plus 60, that is 70. It's as simple as that. As simple as that. Nimeona the past papers that we have, that method has never been tested. So we just proceed to the second method, cash budget method. Cash budget method. Cash budget method. And we write that a cash budget is a financial plan. Is a financial plan that forecasts cash inflows, and outflows, Okay, I've said a cash budget is a financial plan. A cash budget is a financial plan that forecasts cash inflows, and outflows, over a specific period of time. Okay, so I think that one is understood. Dennis, you have gotten it? Good. So let's go to May 2017, question 3A. Option 3A. So if you are there, the question says, the following information relates to Suma Enterprises Limited for the 4 months given below. Sales September, October, November, December. All sales will be made on credit. Half of the debtors are expected to pay within the month of sale and are also expected to claim 2% cash discount. The remaining debtors are expected to pay by the beginning of the following month. Raw material purchases, we are given there. The firm plans to pay its creditors in full in the month following that of purchase. We have the wages and salaries. Additional information is that all employees are paid in the month in which the wage or salary is earned. Rent of 10 million for each quarter is paid in March. So we are given that. Other cash overheads are payable. A new plant due for delivery in September will be paid in November. On 1st of October, the firm plans to have shillings 10 million in the bank. Okay, a cash budget for the 3 months ending in December. So in designing a cash budget, we have details here. Now we begin with receipts. Receipts are what we call the inflows. So I want you to identify that question and tell me the receipts that we have. The items that are bringing money in. The first one that you can see in that question. The receipts that you can see. Yeah, we have sales. And sales, they are all on credit. So we will talk of credit sales or debtors. And these credit sales are divided into 2 categories. There is 50% and there is another 50% because they are paying half. So we don't have any other way that money is coming in. So sasa hiyo huwa tunachora, if we don't have any other, this now we record total receipts. And these total receipts, we designate them as letter A. We designate them as letter A. Then we come now to the side of the outflows, the payments. the payments. So the side of payments, tell me which payments you can see, the outflows, the first one you can see. The first outflow that you can see. Yeah, we have purchases, raw materials purchases. Raw materials purchases, good. Another one that you can see. Another one that you can see. Wages and salaries. That's good, Miriam. Zipporah and Dennis, I hope you are also looking at the same question. Wages and salaries. Another one that you can see. Another one that you can see. Yes, there is rent. Another one. After rent, what else can you see? Yeah, overheads or other overheads, other cash overheads. What else are you able to see? Yes, there is new plant. Good. New plant. That's all. So if that is all, so here we have someone called total payments. Total payments. And these total payments, we call it B. Then we come to balances. The third category, balances. Now in the balances, we have the surplus or deficit. That is A minus B, you call it C. Then you bring the opening balance. The opening balance, we call it D. And finally, we have the closing balance. Now the closing balance is given as C plus D. C plus D. So we have, we are told for the 3 months ending. So that is the month of October, the month of November, and the month of December. So you divide that way. So if we have divided that way, let us now start recording the amounts, starting with sales. And all our figures are in millions. So we can just specify here that shillings in millions. Shillings in millions. So just write that way up there. Shillings in millions. Shillings in millions. Let me bring my camera closer to me so that I'm able to adjust accordingly. Yeah. So shillings in millions. So what we shall do is in September, the sales are not September, in October. In October, the sales are 40. So get 50% of 40, and then that 50%, that 50%, it will be 50% of 40. Then you multiply by 98, 0.98, because we are going to enjoy a discount, or we are going to give them a cash discount of 2%. So tell me that amount. I need more than one person to give the answer. Yeah, 19.6. So that is what we record here, 19.6. The remaining 20, that is 50%, will be payable the following month here in October. The 50% will be payable, in November. the 20%, this 50%. And those who pay after 1 month, they don't get the discount. Then the same will happen for November. So November, we still have the same amount. So we will have this 19.6 and 20 here. And then when we go to December, we have 30. So first of all, get 50%. You multiply by 30. Then
Mwalimu,
yes, Dennis.
you're working with purchases.
Oh, I'm working with purchases.
Yes.
Oh, okay. Thank you. Sure. These are purchases. I had not scrolled up. I'm supposed to be working with sales. So sales up there. In October, they are 60. Okay, so it is 50% of 60 times 0.98. So give me that figure. $29.4. Someone else? Confirm that figure. Okay, 29.4. So the half of it is 30. So that is what we shall receive in the month of November. Then when we go to November, we have 70. So 50% times 70 times 0.98. Yes, 34.3. So half of that is 35, yeah? Then the last month is 90. So 50% of 90 times 0.98. 44.1. Okay, so with that, we need to get this 50, this one. So this must be 50 of the month of September, which was 60. So it is 30. So you now add this one. This will be 59.4. This will be 64.3. This will be 79.1. Let's now go to the payments. Raw materials, we are told that we pay in full the following month. So in October, we are paying what we purchased in September, 20. In November, we are paying what we purchased in October, 40. And in December, we are paying what we got in November, 40. We go to salaries and wages. Now, salaries, we are told that employees are paid in full. Rather, are paid in the month in which the wage or salary is earned. So that means we pay per month. October, we pay 15. November, 17. These are the months we pay 13. Next is rent. Rent for each quarter is paid in March, June, September, and December. So a quarter has how many months? A quarter of an year has how many months? Yeah, 3. Now, this rent of 10 million for each quarter is payable in December. So we come here in December, we pay 10. Higher. Other cash overheads per month are payable. So every month, 2 million here. Then a new plant due for delivery in September will be paid in November at a cost of 25 million. So that is straightforward. The new plant, 25. Then on 1st of October, the farm plans to have 10 million in the bank. That is the opening. Hiyo tutaweka baadaye. So now give me this total. The total for the purchases now. Not the purchases, the payments. This month, 20 plus 15 plus 2. Oh, you can see Zipporah has already given 37 here. 84 and 65. Is it confirmed? Okay, so if it's confirmed, that's great. So now give me what? give me the surplus or the deficit. Unachukua this 59, you minus this 37. $22.4. That is the surplus. Then 64.3 minus 84. Negative 19.7. Next. $14.1. So now the opening balance, the question had said is 10. So you put it there. So you add to this, you get that 2.4. Then that 2.4 so you add 12.7. 12.7 plus 14.1. So that is how we make a cash budget. That is how we make a cash budget. I don't know whether you have any question. If you are okay, say my yes. If you are not okay, ask your question.
I have a question.
Yes.
That part for credit sales,
Mm-hmm.
the 50-50%,
Mm-hmm.
where are we getting it from?
It is in immediately after we are given sales,
Mm-hmm.
there is a statement that says all sales will be made on credit. Can you see it?
Yes.
The next one that follows inasema?
Half of the debtors are expected
Yes.
to pay within the month of sale.
Yeah, half. Half is 50%. Is that okay?
Is okay.
Yeah. So you can either work it 50% or you can say a half of 90. Half is something divided by 2. Good. Dennis, you are saying I clarify on rent. Yeah, I know you thought that this rent is per month. Rent is per month. But now they are saying rent of 10 million for each quarter. That's what I've taken. For each quarter. Yeah. So that has made me to take that it is for the 3 months, not per month. You see where they want per month they are mentioning. Like if you look at number 3, they are very clear that the overheads are per month. So that's why I've taken 10 for the 3. Is that okay, Dennis? Good. Haya. Any other concern? Now, on your own, if you are okay, you shall handle August 2024, question 4C. August 2024, question 4C. August 2024, question 4C. August 2024, question 4C. So that now we proceed on and look at our method number 3. Percentage of sales method. Percentage of sales method. Percentage of sales method. And write that this predicts future financial statement items. This predicts future financial statement items. Future financial statement items based on their historical relationship to sales. Based on their historical relationship to sales. Full stop. It begins by calculating. It begins by calculating. It begins by calculating the historical percentage. The historical percentage of a financial item. Of a financial item to sales. To sales. Financial item to sales. Full stop. The percentage obtained. The percentage obtained. The percentage obtained is applied to future projected sales. Is applied to future projected sales. To future projected sales to forecast that item. To forecast that item. Yeah, that one is as simple as that. What happens is, you look at the historical data. Like we have just ended the month of September, and maybe we had sales, they were 100, and we had something like rent, which was 30. So you express this as a percentage of sales. So when you express it as a percentage, it will be equal to 30 out of 100 times 100. So that tells you rent will be 30% of sales. So if you are told now to predict for the month of, you are told to predict for the month of October, where sales are expected to be 400, where sales are expected to be 400. If you are told to predict rent, it will simply be 30% of the 400. So this cancels there, and you tell us that rent will be 120. That is what we call the percentage of sales. It's just like what you are doing yesterday on the percentage, rather the common size for the income statement. Yeah. So that tells you then this is best used in predicting the items that you'd find in the income statement. So I want us to look at November 2016, question 3A. November 2016, question 3A. Okay, I hope you are there. The question says the management of Georgina Limited wishes to establish the amount of external financial needs for the year ending that 1st of December 2016. Remember, we said forecasting is about determining the financial requirements. The statement of financial position of the company as at that 1st of December was follows. So we have all that. Now the sales for the year ended amounted to 120 million. The company forecast that sales will increase by 10% for the year ending. For the year ended that 1st of December 2015, the after-tax profit of the company amounted to 18 million. The company adopts 80% payout ratio as its dividend policy. The payout ratio is expected to remain constant each year in perpetuity. The after-tax profit margin is also expected to remain constant each year. Assets are expected to vary directly with sales, while accounts payables and accrued expenses form the spontaneous sources of financing. Any external financing will be effected through long-term debt financing. Now, you are required to get the amount of external 12% long-term debt financing that will be required for the year ending that 1st of December 2016. You come up with a forecast statement of financial position for that year and comment on the weaknesses of the method. Okay. A few things that we need to establish. A few things that we need to establish. that have been mentioned in the additional information. That have been mentioned in the additional information. So we are looking at I want to call it what? Determination. Determination of external financing need. Yeah, determination of the external financing need. Now, the first thing that we are able to see, we are told, according to the additional information, the sales for the year ended, they were 120 million. And then the company forecast that sales would increase by 10% for the year ending. So sales sales for the year 2016. Sales for the year 2016. Oh, yes, Serene, how are you? We are dealing with November 2016, question 3A. November 2016, question 3A. November 2016, question 3A. November 2016, question 3A, good. So, right now, the sales are 120 million. So, plus 10%. So, that would be how much? One that two. One that 2 million. The profit for the year ended was 18. The company adopts 80% payout ratio as its dividend policy. The payout ratio is expected to remain the same. So that is not going to affect us. But maybe we could use it this way. Dividends paid in 2015. In 2015, It is 80%. 80% of 18 million. $14.4 million. So the retained earnings in 2015 should be 100 minus 80%. 100 minus what was paid times 18. So that must be 3.6 million. So that is the retained earnings. The next information they mentioned there is the after-tax profit margin is expected to remain the same. So after-tax profit margin. So after-tax profit margin. After-tax profit margin will be 18 out of 120 times 100. That is 15%. That is 15%. So with that, we can also proceed on and talk of dividends paid. No. Before we get dividends paid, we have to get the after-tax profit. The after-tax profit in 2016. The after-tax profit in 2016. Remember, we have said in the percentage of sales, you first of all get the historical percentage. Historical is already what has happened. This one. Then this percentage, you multiply it to, or you apply it to the projected future sales. So the future in 2016, we expect 132. We expect sales of 132, so you get 15% of that. $19.8. So if you want to know the dividends paid in 2016, it is 80% of this 19.8. 15.84. So the retained earnings in 2016, it will be 20% of 19.8. So 20% is what remains here. 100 minus 80. That's what we have there. $3.96. That is the retained earnings. 3.96. 3.96. The next information inasema assets are expected to vary directly with sales. Yeah, so what that means, the percentage we saw of the change in sales will also be reflected here, or the percentage in terms of sales will apply. So sasa, while payables and accrued expenses forms spontaneous sources of financing, so those will be the balancing figures, and any external financing will be effected through long-term debt financing. Okay, and it will be at 12%. It will be at 12%. So in our case here, we are going now to design the financial statement, statement of financial position, and we apply the method as we have said. We apply the method as we have said. So we have the statement of financial position for the year 2016. So what does the question say about it? Saying information 6, assets are expected to vary directly with sales. So if they are varying directly with sales, we are going to see the percentage increase. And let me just start up here. Let me say fixed assets. Fixed assets. The first one is plant and machinery. Now, plant and machinery, right now, they are that 1.2. If we work with figures in millions, so it is that 1.2. You express it as a percentage. So this one is divided by the current sales. The current sales are 120. That will tell you the fixed assets, the plant and machinery is what percent of sales. So if they are varying directly, now you multiply this by the new sales, 132. So instead of first of all expressing it as a percent, you just multiply that way. I hope you have understood what I'm doing. If yes, give me the answer. If not, you can seek clarification. That 4.32. The next fixed asset is furniture and fittings. Furniture and fittings. We do the same. We said we express it as a percentage of sales. So it is 18.72. You divide by the historical sales, 120. Then multiply by the future sales, 132. I have one answer. I need several. 20 points.
Question, mwalimu.
Yes.
Is it a point or it's a comma? Like the 18, is it a comma or it's a point?
It's supposed to be a comma. It's supposed to be a comma. These
Gee.
are typos, eh? What happens when you download these papers from CASNEB, they have a little bit of change. They may not come out original. So if whoever is doing the preparation is not keen, some of those things happen.
So you're writing a point, not a comma, on your
So this one, I'm writing a point. This is a point. But in the question, see, inakaa like that 1.200.
Mm.
Yeah. But it's supposed to be that 1,200 because the figures are in thousands. Sindio?
Yes.
Yapo juu they are in thousands.
Yes.
Yes. So this one, that 1.2, when you convert it now into millions, it is that 1.2.
So
Good. So Dennis, you are saying it's 205. Will you work out? Okay, let's go to motor vehicles. Motor vehicles. So motor vehicles, we have 12.48. You divide by 120 times 132. $13.728. Higher. So we get the total fixed assets. So add those three figures. $69. Is it really exactly 69? Yeah, it should be 68.64. Higher. We now come to current assets. Current assets, we done the same rhythm. Inventory. So inventory, it is 19.2. So it's 19.2. You divide by 120 times 132. $21.12. We can put it somewhere here. 21.12. Let's go to accounts receivables. Or let me just call them receivables. Receivables is 14.4. So 14.4, you divide by 120, you multiply by 1, that's 2. 15.84. So we proceed to the next cash and bank. Cash and bank. So cash and bank is 3.6. You divide by 120, multiply by 132. $3.96. So at that point now, we are able to get what we call total current assets. Total current assets. So add these three, this plus this plus this. 40.92. So tunaileta hapa 40.92. Then we underline here so that now we are able to say total assets. Total assets. So add this to the non-current. $40.92. So 109.56. 109.56. Haya. Then we go to financed by. Financed by. We start with equity. Tuangalie kama kuna components of equity. Sijui kama wako na, yes, they have ordinary share capital. So ordinary share capital, that remains. Ordinary share capital, that does not change. So the ordinary share capital is 42 million. So we just put 42 here. The next component of share capital is premium. Hakuna premium. Then we go to retained earnings. Retained earnings. So we had earlier on computed retained earnings for the year 2016. So remind me, it was what? Yeah, it was 3.96. Now what happens? We work with the accumulated. For the balance brought down, the balance brought down was 17.6. So unaongezea the retained for this year, 3.96. So add these two. $21.56. 21.56. Now, when you get those two, the figure you get is called shareholders' funds. Shareholders' funds. This must be 63.56. Then you come to liabilities, or you can just call them long-term liabilities. Just go straight. Long-term liabilities. Long-term liabilities. So the long-term liabilities, we already have one of them, the 14% debenture. 14% debenture. So 14% debenture. So 14%, that one does not change. So we just bring it here. 10. 14% debenture. We bring it 10. Higher. The next long-term liability. The next long-term liability is what the question is saying will be the 12% long-term debt. So tutaiweka hapa. Itinastahili kufuata hii. So you just say 12% long-term debt. Let me just use the same words. Now that is the one we do not know what it is. That is the one we do not know what it is. This is the one that we are calling the external financing. The external financing. So hiyo tunaiacha. Haya, now we come to current liabilities. Current liabilities. Current liabilities. So current liabilities, we have several. Current liabilities, ukiangalia kwa hii statement, we have the accounts payables. The accounts payables. So the accounts payables, what did the question say? Now, these ones we are told they just form the spontaneous sources of financing. The question is not mentioning directly that they change with change in sales, but because we know we are just told they are spontaneous sources of financing, there are two possibilities of dealing with them. We can either retain them the way they are, or we change them as the sales are changing. Now, the most practical is to change them as the sales are changing, because they are related to sales. They are related to sales. Yeah, you cannot have receivables when you do not have payables. So with that understanding, we will take that currently we have 18. So you divide by 120, then you multiply by 132. Give me that. $19.8. Let me just bring it directly here, out of the interest of time. The next one, anaitwa accrued expenses. Accrued expenses. Accrued expenses, last year they were 12. So 12, you divide by the sales, multiplied by the new sales. $13.2. Then we now say total equity and liabilities we know that the figure must balance. The balance sheet must balance. So whatever we shall get, this should be 109.56. 109.56. So what you shall do to get the external financing, so the external financing will be this 109.56 minus this shareholders funds 63.56 minus these debentures minus these 19.8 minus 13.2. That would be the external financing, which is now the 12%. Give me the answer, give me the answer. Naona wengine wameanza kuingia. So it's 3. Yeah, sasa hiyo 3 ndio utaleta hapa. Yeah, that's what we call the percentage of sales method. Now for your assignment, you can do August 2023. You can do August 2023, question 3B. August 2023, question 3B. Any question? Zipporah is okay. Miriam, are you okay? Dennis is okay. Celine and Miriam, are we okay? No question. Yeah, good. Thank you very much. Let's pick up from there in our next lesson.